You've been lied to. The old way of trading the Forex market is dead. By the time you finish watching this episode, you'll understand why the conventional common way of market analysis is dying and what to do before your account is blown up. My name is Howard Hank, and I lead a hand-picked worldwide team of well-known traders, probably too well-known. In fact, though you've probably seen at least one of our analysts on TV and the newspaper lately, we prefer to remain anonymous, to work behind the scenes and help empower institutions and hedge fund managers when they need to skyrocket their bottom line profits. They turn to us when it matters most, and for good reasons. Here they are in black and white. In 2002, when gold bullion sold for less than $300 an ounce, I advised my followers to start buying gold-related investments. And I did walk the talk, put my own money and my wife's own money in gold-related investments. Now, at the time, the mainstream media labeled us as kooks, crazy, clueless. But boy, did it pay off. The price of gold has risen from $300 an ounce to $1,600 per ounce. It's a gain of 433% in less than a decade. All right, fast forward to 2008 and the financial crisis. We were probably the first in the world to give our subscribers advanced warning, more than a year before it happened. Specifically, we issued urgent failure alerts to our subscribers, warning them about the crisis and the failure of Lehman Brothers, Bear Stearns, Wachovia, Fannie Mae, and General Motors. Okay, more recently, on July 14, 2011, I warned that the market was in a very precarious situation. In fact, here are some direct quotes from what we told our private students at the time. Wobbly markets foretell a difficult autumn. This year has the smell of 2008 to it. My forecast is for increased volatility into the autumn. So what actually happened? Well, the S&P sold off over 200 points in the next 10 days. Imagine what you could have done with this information. However, before we go on, you must know, I'm not perfect. There's always a small amount of risk. Nothing is completely safe. Nothing is 100% accurate. It's the harsh truth. If you want to achieve anything at all, you have to take risks. Otherwise, you'd never cross the road for fear of getting run over. Sure, there are no certainties in life. But there's a difference between a qualified risk and stepping off the curb blindfolded. Here's another truth. While I made my hedge fund clients 7 figures and 8 figures, I'm only taking home, as a commission and a bonus, a little less than 20% of that. And as much as I hate to admit it, I'm still earning less, far less than Steve Cohen and Alexander Baring, the 2 highest paid hedge fund traders on the planet. And yes, it's the nature of things that your returns will be sporadic. Sometimes you'll make much more money than other times. Some weeks you'll need to put in more hours than other weeks. That's life. If you want miracles, go pray for them. I'm certainly not God or even a magician. Now, pay attention, because I'm here to bust a myth. As no one has ever taken the time or had the necessary knowledge to explain the real overriding governing principle of how to succeed in the currency market. See, you make money trading when the majority of the money in the market is on your side of the trade. Okay, let me repeat that. You profit on a trade when you're on the same side of a trade as most of the money in the market at a given time. When most of the money in the market is long in currency, it goes up in price. When most of the money in the market is shorter currency, you guessed it, the price goes down. The question is, who's really in control of most of the money being played? Yes, you guessed it right. 85% of the money is traded by the top investment banks and hedge funds in the world. Now get this. 85% of that money, or about $3.6 trillion a day, is traded by the top investment and hedge funds in the world. Just a few power players dominate currency markets. Do you have any idea how big $1 trillion is? It's 1,000 billion. And even a billion is a difficult number to comprehend. The next time you hear a politician casually use the word billion, think about whether you want the politician to be spending your tax money. And I want to give you a few details which will help you think about what a billion really means. A billion seconds ago, it was 1959. A billion minutes ago, Jesus was alive. 1 billion hours ago, our ancestors were living in the Stone Age. 1 billion days ago, no one walked on 2 feet on the earth. If you are a man and you had 1 billion wives all nagging you at the same time, your brain would explode and you would die in a fraction of a second. Whatever. If you wanted to drive around the equator, you would have to do it 4,000 times before you had driven 1 billion miles. Okay, let's hope your car has air conditioning. And so on and so on and so on. 1 billion is a bunch, a serious bunch. Now understand this. Imagine this scenario. Let's say 5 banks use the following price zones. A, B, and C has major support and resistance levels at which they think the markets will turn. At the same time, 5 other top banks consider C, D, E as important levels to use as support and resistance. And the question is this. If you could somehow get access to their back office and tap into their trading intelligence, which level do you think act as the strongest support resistance? At which level does the market have the greatest probability to turn? Obviously, the answer is C. That's what we call the confluence principle, which states that the strength of your hypothesis is exponentially enhanced by the fusion or combination of more than one factor. Applying the same principle to the field of indicator technical study, think about this scenario carefully before you answer. Let's say Bank 1 uses indicator A to determine the market direction and their entry point. At the same time, Bank 2 uses indicator B for their trend identification and entry timing. Let me ask you this. If you could find a way to fuse or combine both indicator A and B to engineer some kind of hybrid predictive indicator, would that result in an ultra-effective, ultra-accurate indicator that tap into the intelligence and trading expertise of these 2 investment banks? That's exactly what we've accomplished and what we want to give you, but only if that proves to be worth our while. Here's what it's all about. We have succeeded in fusing 2 of the most important, heavily used indicators by top investment banks and hedge funds in the world. Now get this. Not only did we combine the advantages of the 2 indicators, we also achieved something far more important, the synergy effect. In a nutshell, it's when the combination of 2 things results in an end product that is far greater and more powerful than the mere sum of the 2. Let's get more specific. You see, all bank technical traders use indicators as an attempt to help them time and predict moves in the market. Traders have used stochastic, MACD, CCI, and RSI for years. There is no one indicator that will give you every move in the market. If there was, no one would be cab drivers, everyone would be a successful day trader. It's really the combination of several indicators that gives you a higher statistical advantage when trying to predict the market. The main focus of what we teach investment banks and hedge funds is that our patented 9 simultaneous time frames of dynamic support resistance lines and Fibonacci confluence will give you the highest probability for targets and potential trend turning points when looking at any liquid market, whether it's Forex, stocks, bonds, or futures. We then go further and teach them how to implement this newly invented power fuse indicator in order to gauge the strength and potential of those key areas to hold or break. We combine MACD with a Bollinger Band and give us what we will refer to as our power fuse lines. The power fuse is an indicator that will offer insight into the market strength or weakness. When at key areas, the power fuse will provide information about the current market and its expected outcome for the near future. This indicator, once mastered, will be an invaluable tool. Okay, let's dive right into some of the uses of our power fuse indicator. If the power fuse lines are slowing and the bands are coming together, it is indicative of weakening in the current trend and some consolidation or reversal may take place. The swing distance on the MACD Bollinger Bands typically indicates the trend and the momentum. If the power fuse lines are moving rapidly in one direction with very little to no pullback, it is a strong move. This will typically happen after a period of consolidation on the charts. The distance between the MACD-BB lines themselves is also a signal that will help you to determine the strength of the move. The larger the spacing between the MACD-BB lines, the more momentum there will be behind the move. Now let's talk about the MACD-BB strength. When MACD-BB dots move outside the Bollinger Band lines, it will indicate that the market has a lot of momentum. Generally, it will continue in the current direction. If in a position, this will help you to remain patient to maximize your profits. If waiting to enter a new position, it will keep you from getting in too early. Now, here is how to identify the MACD-BB trend. When the MACD-BB lines cross the upper Bollinger Band, the MACD trend is up. When the MACD-BB lines cross the lower Bollinger Band, the MACD trend is down. Here's another use of the indicator. I call it zero-line rejection. A zero-line rejection occurs when the MACD-BB lines reach the zero line and begin to turn. At this point, anticipate the trend to continue. If the MACD-BB lines move through the zero line, then anticipate the trend has changed. Next, Bollinger Band support and resistance. This is expected after a strong move in the MACD-BB lines and is followed by a retracement to the opposite Bollinger Band. It will seem as though the BBs are sliding along the Bollinger Bands and will generally be at key areas. So, when looking at support or resistance, it is essential to make sure that you have some type of indicator that you can rely on to judge the area's potential to hold or break. Remember that there is no one indicator that will give you all the information that you need, but rather a combination of indicators to give you a higher probability of winning your trades and for maximizing profits on any given trade. And that's just 5 of a total 14 methods of using our Power Fuse indicator. And I'll be covering all of these on our tentative invite-only webinar coming up soon. I'll tell you how to apply to get an invitation in just a moment. But before we go on, you need to know this. This is only our 3rd best predictive indicators for traders. That's why we might afford to share it with only serious-minded traders without affecting our hedge fund's performance. The only question is that worth our while? So we want to gauge the market's response and to see if there are retail traders out there who realize its value and are the right fit for this. So what you need to do right now is this. Step 1. Leave a comment below and answer these 2 questions to see if you qualify. 1. Do you recognize the value of this? Are you interested? 2. Why are you the right fit for this? Okay, step 2. Click on the webinar application link somewhere on this page. You'll be walked through a qualification process in order for us to weed out the tire kickers and to make sure you are a right fit for our partner screening webinar. Let me point out that first. If you've ever wanted to make a 6-figure income from your part-time trading, then this strategy is for you. Next, starting with as little as $5,000 today, you could be ready to quit your full-time job in less than a year from now by using this strategy. You see, the median U.S. income is about $46,000. Okay? Using just one strategy from a $50,000 trading account, I made $712,000 in 2011 alone. But if you were copying this strategy and trading right alongside me in 2011, it would have made you $70,000 off a $5,000 trading account. And lastly, if you roll that money another year at 300%, you'll be sitting on $280,000. Can you imagine the look on your wife's face the first time you tell her you made $10,000, $20,000, $50,000 in profits, starting with only $5,000? Better yet, can you imagine the look on your boss's face when you announce you're quitting because you make more money in a few months trading currency than he pays you all year? This is probably the fastest way for you to build a $1 million retirement plan. Even if you've only got a few $1,000s to trade right now, like I said, I've never done less than 300% a year using this specific version of my strategies. Just to be clear, 300% a year is enough to turn $10,000 of your money into over $2.5 million in 4 years. 4 years. But I need a favor from you first. Do the 2 steps I just mentioned. Leave a comment below this video. Tell me 2 things. 1. Do you recognize the value of this? Are you interested? 2. Why are you the right fit for this? Then, step number 2, click on the webinar application link to start your qualification process. Now, I'll be honest, I am anticipating a pretty strong response because I know this system beats 99% of everything ever made available to individual traders. I'd really appreciate it if you take the time to leave a comment. Thank you. Until next time, Howard Hank, signing off.